So first, I just want to say a quick hello to everyone and thank you for joining us for today's webinar on responsible finance and impact investment. I'm very pleased to introduce today's speakers. So we have Sarah Gordon, who's the Chief Executive of the Impact Investing Institute. Prior to this, she was at the Financial Times for 18 years and was most recently the business editor there. She has held roles at Citigroup, Foreign and Colonial, and the UN Conference for Trade and Development. And she was also on the panel for a recent independent inquiry into the future of civil society. Sarah will be interviewed by Ed Siegel, who's the Chief Executive of Charity Bank, a responsible finance member. And Ed joined Charity Bank in 2018, and before that he was Managing Director at Big Issue Invest, which grew substantially and raised new funds under Ed's leadership. Ed has held roles across social investment, corporate banking, and business consulting, including at Credit Suisse and Shore Bank International. So thank you both very much for joining us. So now for some housekeeping. The webinar will be recorded and we'll share it afterwards. And I also want to say thank you to those who sent in questions ahead of time. Ed and Sarah will cover these off during the discussion. If you would like to submit any comments or questions into the chat function, we'll make sure to incorporate them in future discussions on this topic. So thanks again to everyone for joining us, and I'll hand it over to Ed to get started.
Thanks, Theo, and welcome to everyone who's dialed in today. I guess from the message we received from Steve, you can see and hear us, but we can't see you. If you do have questions over the course of the discussion, please use the chat function and we'll see if we can incorporate them if we have time. Further ado, we've got some questions for Sarah, some that you've sent in and some that I've come up with myself. And I'd just like to start by asking Sarah to tell us a bit more about the Impact Investing Institute, what it is, what it aims to do, and I guess importantly for me, I think it's important to get out there what it doesn't do, what it's not.
Thanks, Ed. And just to warn everybody, I shared this with Theo before we started. I'm unusually in the office today, and the office internet is proving less reliable than my internet on Exmoor, where I live normally. So if I disappear, I will come back or tether to my phone. So just apologies in advance if that does happen. So the Institute was launched last November. Our mandate is to increase the growth of the impact investing market nationally and internationally, but also to improve its effectiveness. So it's not just about trying to encourage more impact investment, but trying to make it more effective and more accountable. And I spent a lot of, I mean, it seems much more than a year ago, given the year it's been, but I spent much of last autumn building on the work of the two organisations which merged into the Institute, which were the Task Force for implementing a culture of social impact investment in the UK, which was backed by government and run by Elizabeth Corley, who's now the chair, one of the chairs of the Institute, and the National Advisory Board on Impact Investment, which was chaired by Harvey McGrath. And these two organisations merged into the Institute, because unlike most organisations or indeed countries or regions, they felt they were trying to do the same thing and that they would be stronger together. And really we tried to identify both what the market needs were that we were well placed to address, and also, as you say, what we were not, what we weren't going to add value, where we weren't going to add value. So our comparative advantage really is the fact that we have really strong links with institutional investors, so investors of capital that's domiciled in the city or in London at least. And we're really trying to facilitate better links between that capital and better understanding of impact with those asset owners and asset managers, and not just better understanding of, but greater engagement with impact and greater allocation to impact. So we have a number of different work streams which address different needs around education and awareness. We have a big policy and advocacy piece of work, and we're also about building evidence, because in some of the conversations that we have with institutional investors, one of the big hurdles that they experience in terms of engaging with impact is what they say is a lack of evidence of suitable investments or investments at scale. So I think what's also particularly relevant to note for the audience today is that we have a social investment work stream where we are working with a group of social investors and others, particularly around trying to get the social sector broadly, so social enterprises and the social investment sector, higher up the agenda of government, because this current administration, as many, well, probably everybody in the audience is aware, does not appear to have a very good understanding of the social sector broadly, or the social economy, and the contribution that social enterprises and social investors make both to local and indeed the national economy, is particularly important given the pandemic. So I could go on, but I'll shut up and let you ask me another question.
No, that's really helpful. I just wanted to follow up on a point that you made. What I've heard, what I wanted to elicit is what you're not, to be clear to everyone who has any doubts, is an investor. Right? You're not a wholesaler. You're not another big society capital. You are trying to grow the market. And from what you said, an important strand for you is to try to bring the mainstream investing world more into this idea of impact investing, social investing, if you will. One of the things you mentioned was a perceived lack of evidence of what you called suitable investments or investments at scale. Can you elaborate a little bit on those points? Because it actually speaks to one of the first questions that one of the members has asked around investing at scale.
If you go to, for example, some pension schemes, particularly local government pension schemes, are very engaged with the discussion around impacts and very aware of the impact of their investments and wanting to make investments, for example, in their own community. I'd say a more standard and traditional response from a pension scheme trustee is that impact investment is not for us because it involves concessionary returns, and we're focused on making financial returns for our members. And they say, and there are no impact investments are not suitable for us. They're niche, they're small, they don't have any track record, or at least a track record that we would be comfortable with. And they're not in the kinds of asset classes that we're familiar with. So one of the things that we're trying to do is to present evidence of suitable at-scale impact investments across different asset classes. So, as you'll know, impact has tended to focus, so people like Bridges have tended to focus on private markets rather than public markets. But we believe that you can deliver impact across a range of different asset classes, both in public and private markets. We're focusing in particular on two asset classes at the moment. One I'll just quickly talk about is social and affordable housing, because most mainstream investors have a familiarity with property investment and a comfort level with property investment. Social and affordable housing has, many investors, many housing associations have been delivering impact for decades. They don't necessarily talk about it using that vocabulary or define or hold themselves accountable for their impact. But however, it is an incredibly important asset class, and at a scale and with the sort of investment opportunities that a mainstream investor with a considerable portfolio to manage can think constructively about investing in.
Thanks, that's helpful. I imagine you've done a lot of homework since you took on this role. Can you give us a helicopter view of of what you see as the wider impact investing market. You know, who participates, how big is it, and maybe a profile of some of the investment propositions that are out there.
Sure, it's certainly true that I had to do a lot of homework, because I was as Theo said, I was a journalist for 18 years. A writer on everything and an expert in none. So yes, I've been on a very steep learning curve over the last year, and I think, you know, there are a number of people in this world, and I think in this audience, who really helped me on that learning journey. Just to answer your question, there's a really increasing number of what you can call mainstream asset managers that have entered the impact investing market. How much impact they are delivering for the products that they describe as such is a really interesting and challenging question that we can explore a bit if useful. The social investment market has grown massively. I mean, there were 4 funds identified as social investment funds in 2012, and there are over 40 now. But in terms of the more mainstream asset managers, Apollo Global Management is the largest private equity manager that engages with impact. So it has $400 billion in alternatives and $75 billion in private equity. But you've also got other private equity managers like TPG, KKR and Bain Capital. In the UK, which is obviously the focus, I believe, for the audience, most of the audience today, Bailey Gifford, Aberdeen Standard, M&G, Barclays are all some of the firms which have really, I think, you know, they've really tried to think carefully about what impact investment is, what they can do, and how they should think about it. So I think, you know, I don't want to overstate the involvement of those mainstream managers in impact. Even the ones that are pioneering are at quite an early stage. And they're also hampered, as we'll probably talk about later, they're hampered by a lack of standard vocabulary in this area. So you've got a lot of firms doing a lot of individual activities, but it's quite difficult to compare across firms sort of either products or indeed the impact that they're having. There are also a lot, as you'll all know, sort of boutique impact managers with strong impact expertise. So I talked about Bridges already. There's Resonance. There's many others. The estimate of the global market size is just over $700 billion US, and we can have another discussion about how much of that really is genuine impact investment. The social investment market in the UK is about £5 billion. And I think, you know, looking at what the sort of more recent developments are, there are a lot of, I think it's fair to say that there are a lot of statements about impact by the mainstream asset managers. And there is often a rather weak translation from those statements into actual actions. So it's quite easy to call a fund an impact fund or an ESG fund, but to actually demonstrate that you are delivering impact in those funds is a different matter.
I mean, that's, as we know, it's become a very, very, very broad church, and I think as a social investment intermediary ourselves, I'm always, you know, it's great that the mainstream has woken up to this, but I fear that for many of them, it's a big business opportunity, and there's a risk that those of us who are on sort of the social impact first end of things get lost in all of the buzz that's going on. Have you seen any notable developments in the market in this crazy year of COVID?
Yes, I mean, all I would say though, just before I answer that, on your observation, but I mean, I know from my time as a business journalist, you know, markets develop in lots of push-pull ways, and you know, there are the people who've been involved in delivering impact, and there are people who've been mediating the investment to those organizations or groups or individuals. And then, like you say, there are the big asset managers or indeed asset owners, and they are responding to client demand. And that's, so a lot of the statements are a response to demand rather than a really sort of integrated and internalized change. And then at the same time, we've also got policymakers and regulators who are pushing for this, particularly on the environmental, you know, in terms of environmental related regulation. And I think what you've got is this kind of slightly Wild West situation where there are lots of different impulses and pushes and pulls, and some of them are commercial and some of them are ethical and some of them are environmental. And but you know, you will move to a clearer, you know, you'll move to a more accountable environment in the future. I mean, what we're here is partly to try and help put pressure on both the firms and the regulators and the policymakers to increase transparency and accountability, because that's the key thing. I mean, COVID, I mean, when I first started this job just over a year ago, one of our concerns at the Institute was that the climate emergency, pressing as it is and was and is and continues to be, was drowning out the sort of emphasis on the S in ESG, that the recognition that you know, that investment and investors should be thinking more about the social impact they were delivering, or the negative social impact they were having, was being drowned out by the powerful and rightly powerful and influential voices talking about the need to address the climate emergency. What I think has happened with the pandemic, and you know, I wish it hadn't happened, but it's made the impact of the pandemic has demonstrated how social inequities nationally and internationally have massively worsened what has happened with the effects of the pandemic. So, you know, whether that's access to affordable healthcare or access to decent shelter or clean running water, education, I think it's really brought people and even, you know, particularly people in more privileged societies like our own, really upfront with some of the, you know, the desperate social injustices in this country and across the globe, and that we need to address them, not just because it's the right thing to do, but because it increases your resilience and your ability to withstand the impact of a terrible situation such as the one we're facing. So I feel it's really elevated the S. And I mean, we think, you know, we think that you can't think about the environment without thinking about society, and that, you know, when you're talking about a transition to a net zero carbon economy, you have to be thinking about mitigating the negative social consequences of that, and also seizing the social opportunities of that transition. And you can't, but to think about the E without the S is wrong. And to be honest, I think that the situation, the pandemic has, it's helped people really understand that argument and engage with that argument. So I mean, I'm of course not saying that it's good that it's happened, but I think in terms of the sense of momentum behind what we're all trying to do, I do feel it has added to it.
Yeah. No, I agree. I think this really unfortunate situation has created lots of interesting opportunities, and you know, we perhaps are experiencing a moment that we need to try to take advantage of. Amongst the responsible finance membership, certainly a lot of people who are on this call, speaking for organizations that I'm involved with or have been involved with in the past, you know, attracting investment into our funds, into our intermediaries is kind of a never-ending challenge. And I'm pretty confident it's It's not something that any of us have really nailed effectively. It's a lot of work, a lot of frustration. So maybe early days to ask you to give us a clear answer to this question, but what do you think, from what you know of the Responsible Finance membership, what can we be doing to make ourselves or make our organizations more attractive, more compelling impact investment propositions? How important is financial return? How important is impact reporting and measurement? Or is it, are the stories, the sort of emotional impact just as important as the hard data?
Yeah, lots of points, there. I mean, I think one of the things that's really struck me in terms of the relationship between the banks or other mainstream investors in the CDFIs is that I mean, we worked very closely with social investment business and big society capital in the immediate aftermath of the lockdown, when both organisations, and particularly SIB, was trying to channel more loans to social enterprises, charities and SMEs in disadvantaged areas of the UK. And one of the roles that we had, which is part of what the Institute is trying to do, is to get connections and conversations going with organisations that don't necessarily talk to each other as often as we feel they should. So we were connecting the high street banks with SIB, with others involved in this initiative. And it's very striking to me. I mean, I ran the company's desk at the Financial Times during the last financial crisis. It's very striking to me how little expertise there is in the high street banks to understand either small businesses or CDFIs and their role in the economy and in communities. There's an actual disconnect between many of the high street banks and communities in the broadest sense, but in particular, they've small business expertise and sort of related expertise was really got rid of in the wake of the last financial crisis, and they haven't rebuilt it. And I mean, one of the absolutely critical things that I think we should be thinking about is rebuilding that expertise, because we need to be getting more money into communities, not just because of the pandemic, but because the government says it wants to level up regional inequalities. So that would be a critical response. But just in terms of the specifics as to how to make sort of increase the attractiveness of the CDFI sector as a whole. I mean, I'm a former journalist, so obviously I think stories are really important. And I mean, that sounds a facetious answer, but I don't mean it at all. I think a mixture of hard data and narrative is incredibly important in any kind of communication. I think that there's quite a lot of misperceptions about CDFIs and how financially sustainable they are, that there's there needs to be a more accurate story told about the financial sustainability of most CDFIs, and about things like defaults and on the reporting front, I mean, it's a really difficult. I mean, I can't give you a clear answer on that, because we need to have a language to report on impact that is shared by everyone. And one of the things we're doing at the Institute is working with the Impact Management Project and others on getting to that place. I mean, I think we will get to a place where there is the equivalent of an IFRS for impact. We will talk about impact in a standard way, but at the moment we don't. I mean, there are you have options. Aligning your reporting with the SDGs there are lots of that appeals to a lot of the mainstream because they understand the SDGs. But as you all know, the SDGs are very high level. you can, it's quite easy to tick a particular SDG, but the link between the activity on the ground or the investment on the ground in a specific SDG is really, it tends to be pretty tenuous. So, that said, the SDGs do provide a common language, and, the Impact Management Project, of course, is working to link, link the particular reporting on impact to specific SDGs, and I think that can be helpful. Also, as you know, there's real efforts around convergence of global standards around reporting and measurement of impact, which I do think will help. And things are moving quite fast.
We're going to now, I'm moving into a set of questions that were sent across by the members ahead of this call. Some of which have been partially answered already, so I may dance around them a little bit. And I guess I'd also encourage the people on the call today to just go ahead and send in questions. I've seen one come in, and we'll see if we can fit them into the flow today. And if not, we'll if we run out of time, we'll try to take them offline. So the first question comes from Mick Brown of Robert Owen Community Banking. And this comes back to the question of investing at scale. What scale are impact investors seeking to invest in? How can responsible finance members make themselves known to the likes of pension funds and the wider universe of impact investors who may be looking for larger scale investments? And I guess I would add on to this question, you had written recently in a blog that I saw on Pioneer's post around the myth of fiduciary duty, which is something that I've come up against in trying to raise money from city investors.
Yeah. The question of scale is incredibly important, and we talked about it a bit earlier. But if you're talking about banks or pension funds or corporates, that for reasons of cost effectiveness apart from anything else, they're looking to invest hundreds of millions, not tens of millions. Some local authority pension schemes make smaller investments, but on the whole, pension funds usually invest upwards of, £100 million is the minimum. So, one of the things that, and I'm sure this is something that has been considered and talked about in the sector. Pooling investments could be one route to enabling pension funds to better invest in CDFIs. And we're working with Pensions for Purpose and the Good Economy to identify current opportunities to make impact investments in place. So we're looking at how local authority pension schemes, what local authority pension schemes, what impact investments in place they have done, and what lessons there are from that for other big investors such as pension schemes, and that includes an SME finance component. So that's work that's ongoing. So I look forward to sharing that with you with Responsible Finance. The other issue, as well as scale, is ensuring what tax reliefs can be offered to make the investment more attractive. And obviously community investment tax relief is really, it's important. It's possibly less used than, I think it is much less used than it should be. And there's a lack of awareness around it. I know you, Ed, know everything about CITR, but making more mainstream investors aware of how CITR can be used really is a really important element. And we can talk about that in more detail if that's of interest. On fiduciary duty, one of the very first conversations I had at the Institute when I went to see a large FTSE 100 pension scheme, and they said, we can't even think about doing impact investment because it's not compatible with our fiduciary duty. And this is a really big sticking point. And when I talked earlier about what the institute is trying to do. You know, we're trying to lower, when you come up with the objection, we're trying to have the answer to the objection. And this particular objection is it's very widespread, it's very widely held. So we believe that not only is impact investment compatible with fiduciary duty, but that in fact you can make a very strong case for, if you neglect, if you don't think about impact, you are actually neglecting your fiduciary duty. And we have a pro bono legal panel that works with us, and we've written a paper, I think of it as a reassurance document for fiduciaries to make the point, to make these points that fiduciary duty is compatible with impact investment. But we've also developed a set of what we're calling good governance principles to guide conversations at trustee and other sort of fiduciary level discussions, really to sort of how you need to, once you've got over the hurdle of thinking that your fiduciary duty is not compatible with impact investment, how then do you start thinking about incorporating impact into your investment processes and your statement of investment principles, and indeed your asset allocation?
I think that's absolutely right. And I think another thing that's missing in the dialogue there with big institutional investors is, you know, why don't you ask your pension holders what they want?
No.
Right? Why don't you ask your insurance policy holders what they'd like? You know, there's an insurer in Australia, QBE, that asked its policy holder, if you would be happy for us to invest, I think it's 5% of your premiums in social impact investments that may earn a sub-market return, tick this box. And a lot of people tick that box, and as a result, they've got, I think it's like £100 million fund to invest around the world in social impact. But that's a big ask for these institutions, because it's a headache to actually ask customers if they'd like to do things a little bit differently. Although,
I mean, you know, as we were saying earlier, I mean, you know, the investors, asset managers, asset owners, I mean, they respond to demand, to client demand. And I think, I mean, we're working with a number of organizations that are really, you know, like Make My Money Matter, which is really trying to make people feel more, individuals, you know, members of the public feel more empowered about the impact of their money. So not just their investments, but their savings, their bank accounts, you know, what they spend as a consumer. And I think there is, you know, all the evidence is that I always get quite, you know, people always say, oh, it's, you know, the millennials, people like Theo really mind about this stuff. Well, I really mind about this stuff as well. And, you know, the evidence of sort of all surveys of the public is that, you know, an overwhelming majority, if given the option, want their savings and investments to be used to deliver good for people and the planet. Mm-hmm. The problem is with things like pensions, we know that that very few people actually are actively involved in making choices for their pension funds. Now, obviously, we can argue that they should have more ability to do so and they should be encouraged to do so, and I agree with all of that. But we also believe that pension schemes should be incorporating, as a minimum, there should be ESG integration in their default funds. Sure. So and that their default fund should include an allocation to impact.
I agree. I'm going to read another question. To what extent does the impact adjusted return de-risk the investment for an impact investor? This comes from Philip Bazin from Triodos Bank. And I think we talked about what this question actually meant. It's this idea that if we are suggesting a concessionary rate of return, an impact, a discount for social impact, is there also a rationale there that this somehow should, you know, that there's a lower risk implication in that lower return?
Yeah, I mean, I mean, there are impact investors increasingly come in lots of different shapes and sizes, and I mean, the audience today is you know, as aware as I am of the, the finance first impact investors and the impact first impact investors. And obviously, if you are an impact first investor, you often are prepared to accept a concessionary financial return in return for the impact that you are delivering. And, it's often seen as a kind of trade-off, the more impact, the more concession. Now, I think that is one of the sort of accepted truisms, I suppose, that we're really trying to look at in some detail. I think the challenge for mainstream investors is that if they think the more impact, the less financial return, that would tend to move them much more to the finance first end of the spectrum. And it's not necessarily always the case that the more impact you deliver, the lower the financial return. And what it is about in all these questions is it's about transparency and accountability and how you report on the impact. Because we don't know, I mean, so few mainstream investors at the moment even think about the impact that they're delivering, or the negative as well as the positive, that they are simply not aware of the potential trade-offs or even the relationship between the impact and the financial return. I mean, what we feel, what we believe very strongly is that we will get, at some point in the future, we will get to a point where you consider your return in both financial and impact, in a financial and an impact sense, i.e. you will be thinking about the impact that you're having, and I mean the negative and the positive impact, as well as the financial return. And I mean, some of you will be aware of maybe all of you will be aware of the interesting work that's been done at Harvard, trying to quantify, put a number on the impact. And I think there's a lot of, it's really difficult to do. And, there's a really live and very valuable debate about whether you can reduce impact to a number. And we talked earlier about stories and data. I mean, a lot of the impact is a story. It's not a data point. That said, I think that you will increasingly have to be transparent about your negative and your positive impact, and therefore about the relationship of that to the financial return you deliver. I mean, just incidentally, I mean, the first sector that the Harvard work has focused on is the oil industry. And when you look at the cost of the negative impact that this industry is having, it so massively reduces the financial return that in theory is being delivered. Mm-hmm. And I mean, that gives a very strong indication of, I think, how we will see the interrelatedness of the impact and the financial return measures in the future.
Mm-hmm. For as long as I've been doing this, I think for many conventional investors, being able to quantify social impact or give it a score is sort of the holy grail, because it's how they're used to looking at things, with a Morningstar rating, and it's I'm not convinced we'll ever get there. I do think with impact, there is a great deal of sort of value judgment and personal preference that comes into play.
But I think, Ed, I mean, where, that comes back to this issue about the interrelatedness of the individual, the business, and the regulator and policymaker. Because if businesses, if organizations have to be much more transparent about the negative as well as the positive impacts that they deliver, it will be much clearer to regulators and policymakers what an appropriate response should be. So, for example, if you are producing oil, but you are massively polluting your surrounding environment, and you are uprooting communities and destroying jobs in the process, I think that all the momentum is behind you having, as a business, you having to account for that, and therefore the response by policymakers and regulators will be to take account of that, whether it's through taxes or other forms of regulation. So it's not just the asset management firms or the investors, or it's the whole set of actors.
Yeah. I have another question here from Steve Walker at Art Business Loans. Coming back to you mentioned community investment tax relief, CITR, of which some of us are big users, but it really is not well known. And see, in my experience, when you actually get a conventional investor to take the time to understand what it is and then be convinced that it's real, it's a great deal.
It is.
It really can be successful, but for some reason it really hasn't been taken up. So Steve's question is, can you give us an indication, if you know, of the success or failure of attempts to encourage individuals to invest for impact, and what could or should be done to improve knowledge and awareness of the tax relief, such as CITR, but also SITR? Yeah.
Well, I think the SITR mention is a really important one, because it's really interesting to us that there is more, that we think there is more understanding in the market of SITR than there is of CITR, and in many ways CITR is a much more effective and better instrument for what we're trying to do. It would be good to know, apart from anything else, it'd be quite good to know from you how you think improving knowledge of CITR, how we should be going about it. For CDFI investments in particular, CITR, we think, is the relief that is the one that makes them, it's the most useful mechanism to help make CDFI investments attractive, because it subsidizes the intermediary and not the social enterprise, which is what SITR does. And SITR, there's a big debate around it at the moment, as you know, because it's due to expire in April 2021. And so far, if you are one of the 76 organisations that has used SITR, you want it to be retained or enhanced. And CITR is obviously, it's more generous, so it's 30%, and it's all in the first year, whereas CITR it's
5% per annum for 5 years.
Yeah. So SITR looks more immediately appealing, but we think at the Institute that getting CITR enhanced and more well known would be as effective as renewing or extending SITR. Yeah. So and there are a lot of there are a lot of conversations within government about what should replace SITR, and we're sort of engaging in those discussions along those lines, that in many ways CITR is, if better known, a more effective instrument. What do you think in terms of, it'd be useful for us at the Institute to know, as a someone who uses it a lot, why isn't it better known?
Well, I think one of the reasons is it's been around for a very long time, and it's been a very long time since any kind of organized campaign to promote the scheme, to raise awareness of the scheme, has been undertaken. Unlike as we saw with SITR in the last couple of years, driven largely by big sided capital, I'd say. It's been pretty quiet about CITR. As you may know, and some of us know, I think the concern is always that CITR not only will it be forgotten, it'll be canceled because there hasn't been enough take up. We also believe that it could do with some enhancements that would make it even more powerful. it hasn't been touched for, I don't know, 18 years or something. It's definitely due for an upgrade, and maybe take the opportunity to get the word out, because it's really effective. 10 minutes to go. I've got one more question from my list and one on the screen. This is from Lindsay Wake, Social Investment Scotland. What are the gaps that impact investors see in terms of the climate emergency, and how can CDFIs position themselves to fill that gap?
Yes, I think that, I mean, that refers a bit to what I was talking about earlier about the way that we see the climate emergency and the environment is very directly linked to the social challenges, both in this country and outside it. And I certainly feel that CDFIs are very, from my relatively limited knowledge, appear very well positioned to make the case for that incredibly important linkage between measures taken both at a national and a local level to transition to a net zero carbon economy, but what that means for communities, and indeed, what opportunities that provides in terms of, whether it's reskilling or the opportunities around location of things like wind farms, and what that does in terms of regeneration of local areas. Or, I mean, one of the impact investments that we talk about a lot at the Institute is there's a bridges investment in what was a former coal mine, which has been repurposed. So the buildings have been repurposed as it's essentially a renewable energy project. The buildings themselves have been constructed in a very much more carbon neutral way than obviously the original buildings were, but most standard buildings now, and it's created 450 jobs. And I think that example it's a very good one of how the transition to a net zero economy can create job opportunities, can create opportunities for urban renewal, and that both identifying those opportunities and describing them, it feels to me like CDFIs are pretty uniquely placed to do that.
Mm-hmm, mm-hmm. So I've got one question on the screen here from Peter Udale, and I'm not sure if it's for you, Sarah, or for me because of my accent, because I get asked this question a fair bit over the years. Can you comment on what lessons we can learn from the US in terms of the role of government in making the sector more investable? If you'd like, I could.
I will be interested in your views, Ed. I mean, I think just a couple of points on that. I mean, depending on what happens on the 3rd of November, I mean, the current US government is putting in retrogressive measures. It's making the sector less investable, not more investable, and it's extremely worrying and concerning. One of the really, however, on a more positive note, one of the things that we really try to talk to government and local authorities about a lot is the municipal bond market in the US, and the vibrancy both of that bond market, but also the way that it is linked to local projects, local communities delivering on local priorities. And this is something that really doesn't happen in the UK. It happens a little bit, and there are some local authorities and some regions which are sort of dipping their toes in the bond market. But we think there's real opportunities for impact investment and investors in that space. Why? Well, we've just presented a proposal to government on a green plus sovereign bond, which which combines social and environmental positive impacts, as I've been talking about earlier. And we think there are even more opportunities. One of the reasons that we want the government to do this is because we think this will give an incredibly important signal to local authorities to follow suit in the UK, because it will, you know, it'll just help market development.
Mm-hmm.
And we think, you know, this could be for local authorities to have a broader, deeper, better functioning municipal bond market in the UK, as happens in the US, is something that could really help drive mainstream finance to local priorities.
Mm-hmm.
But I'll hand over to the expert.
Well, I'm not the expert, really. I mean, every time I get asked this, I have to remind people that I left the States a long time ago, so I'm not. It's been quite some time since I've been very well connected to the movement in the States. But what I will say is that, you know, what they have in the States that they don't have here, that most people know, is the Community Reinvestment Act, which compels commercial banks, mainly in the States, to meet their community investment obligations. And many do so by investing in CDFIs. And you don't have that here, and I don't think, I've never got the sense that we ever got close to that becoming any kind of a reality. But I do think that, you know, it comes back to, you know, maybe the collective membership here doing a bit more on the campaigning side of things, because, you know, really what we all do is fulfill what really should be the social function of the banking sector or the mainstream financial sector, right? We do the stuff that the banks don't want to do because they can't make enough money doing it, or they think it's too risky, or it's just too hard. And, you know, that's fine. There's probably good business reasons for that. Nevertheless, there is, you know, we're doing it and fulfilling an important role. So to my mind, it's a pretty, you know, natural progression to, hey guys, we're doing what you should be doing. You don't want to do it. Why don't you help out by capitalizing us so we can do it more sustainably? And the kinds of, you know, the amounts of money we're talking about are very manageable. You know, I know Steve Walker, for example, and myself, we're giddy when we get an investment of £250,000. An investment of £5 million would be transformational and very affordable for the Barclays of the world. And I think we could be doing more to sort of encourage, and this is a year of opportunity, as you've said, you know, to encourage the sector, the mainstream sector, to do a little bit that would go a very long way.
Yeah, I mean, on that, I mean, certainly the conversations that I was referring to earlier with the mainstream banks I think there is a genuine willingness at a number of banks to get more informed and to understand the CDFIs better, and to understand better how they could work together with the CDFIs. I think that there would be, you know, there are two things that from the last year I would suggest that would help. And, you know, one of the things I talked about earlier, which is the possibility of pooling investments. But I think there is also something around the story and the narrative that you communicate, that the CDFIs communicate. Oh, sorry, my light's gone off. Which is, and, you know, one of the things that we've been doing with social investors, you know, is that as a whole, creating a narrative that speaks for all CDFIs or that speaks for all social investors is a much more powerful one than one that speaks for individual organizations or initiatives. And, you know, having a voice, both with the banks and with government, or having a more joined up voice, I would suggest might help that engagement. And we're here to help if we can be of any assistance on that.
Well, I really That's a helpful way to end, Sarah. We're at 11 o'clock now. I really appreciate you allowing yourself to be put on the spot. You know, I've been at it for, I don't know, 16 years here in the UK, and I'm still getting up the learning curve. So you've done a remarkable job, and you're quite brave to stand in the firing line for some of these questions at such an early stage in your time with the Institute. So thanks again. Theo, do you want to close?
Yeah, sure. Well, thanks again, both Ed and Sarah. That was a really interesting and informative discussion, which I think left us with a lot of food for thought that, you know, we can take forward collaboratively. So thanks again to you both for taking the time today to have this discussion, and thanks to all of the attendees and members who joined today. And we look forward to continuing this work.
Yeah, thanks very much. Real pleasure.
Thank you. Thanks, everyone.
Okay, take care, everyone.